Hey everyone, this is chapter 9 of Trading Price Action Trends. It's exchange traded funds and inverse charts. So a pretty short chapter, but a couple of important points here that I think are very helpful. So the main idea in chapter 9 is Al recommending that traders change something about the chart in front of them to get a different perspective on what they're seeing. And the first change that he recommends is using a line chart. As mentioned in chapter 8, Al talks about the importance of the closes of the bars and that many institutions use line charts. And so it'd be important for retail traders to also get an idea of what the line chart looks like. One important reason to use a line chart is that it gives us a sense of body gaps staying open. So here we have a breakout above this high, and there isn't any overlap. So this pullback doesn't get below the breakout point. But then here we have a breakout, and this pullback does get below that breakout point. And this pullback gets below this breakout point. And so this one isn't really hard to see, but even though we're getting overlap between the pullbacks and the breakout points, all the body gaps are staying open. And using a line chart makes that obvious. It's not as hard to see on this chart, but there are some charts where it's not as easy to see. And using a line chart will make it really clear. So we can see from down here, we get a pullback and a breakout, and then this pullback doesn't overlap with this one. So these are the closes of the bars. So all these body gaps after every breakout are staying open, which are signs of strength and can indicate a larger protracted bull trend. In this case, we got the upside breakout. The second thing we can change about a chart is to look at a lower time frame or a higher time frame. So just as a simple example, looking at this is the ES daily chart, and we have a bear channel. And by looking at this, it's important to understand what context this is happening in. And an easy way to see the context is to just go up a couple time frames. So from the daily chart, we go to the monthly chart, and we see that whole bear channel is just a tiny pullback in a much stronger bull trend. And if you go even higher to a 6-month chart, it's just one bear bar coming after 30 bull bars and 3 really big bull bars. So it increases the likelihood by seeing the higher time frame that this is just a pullback in a larger bull trend. Whereas the lower you go in terms of time frames, the more detail you see, and the more every move looks like a larger trend. And so that same pullback on the 1-hour chart is a really long bear channel. And it kind of brings you into the detail of the chart, but it doesn't give you quite as clear of a picture of what's happening overall as the overall context. So looking at a higher time frame is useful because it gives us an idea of the overall context. But looking at the lower time frame also has its set of benefits. So when you look at a chart like this on the lower time frame, if you're on a really high time frame, then all you might see is, for example, here you'll see a bear bar and a doji. So the higher time frame shows more of a displacement, like where did the price go? It started up here and it ended down here, and it only shows us 2 bars. Whereas the lower time frame shows us more of the distance traveled and how it got there. So here we see 2 bars. We know that there was a sell-off and then a pause, whereas a lower time frame will show us the actual path that it took to get there. And when we go to a lower time frame, we see more of the internal structure. We see more of how many legs it took to get there. And when you look at this, it becomes much more clear that this moment here, so for example, on the 6-month chart, after the bear bar and the doji, this next bar starts on January 3rd. And if we go to the daily chart to January 3rd, it gives us a clear picture that this is possibly lower low major trend reversal. So we have a lower low major trend reversal, possible higher low major trend reversal. And so on this time frame, there's a lot more information to place trades because it shows us the path that it took and that it's a possible reversal and a wedge bull flag. Whereas on the higher time frame, you see the overall context, you understand the general probabilities and direction, but you don't have as much detail and structural information. The last thing that Al recommends, which I think has the biggest impact and has had the biggest impact for me, is to look at an opposite chart. So most traders are typically bull biased. So every pullback in a bull trend looks like a pullback, looks like a bull flag, but every pullback in a bear trend looks like a possible reversal. So we're always thinking that the market's going to rally, even when it's in a bear trend. Something that's probably a minor reversal, like this, often looks like the start of a possible major trend reversal. And so a good way to kind of see the opposite side or the opposite case is to look at a flip chart. So one way to see a flip chart of the ES is to look at the SDS, which is an inverse of was twice leveraged inverse of the SPY. So if we go to SDS here, you can see that it's an inverse or flip chart of the E-mini or the micro E-mini or SPY. So I'm just go to SPY here. So this is SPY and this is SDS. So for example, if we're looking at something like this on ES, my tendency, and I think a lot of traders' tendency, is to look for major trend reversals because the market's falling and the typical bias is to expect a reversal up. And so after this test of the moving average, we're looking for a major trend reversal, and you never quite get into the mode of seeing it as a bear trend. But using a flip chart, so if we flip this to SDS, it gives us a sense of the bull case. So now this kind of more instinctively or intuitively looks like a bull trend, a bull flag. Now we're looking for trend resumption up. And so it just becomes much easier to buy looking at this chart, which would also make it easier to sell looking at the real chart going down. So it just kind of gives you a shift in perspective to see the other side and potentially get more insight on the chart you're looking at. Now for on TradingView, if I go to any chart, so for ES or SPY, you can use SDS as the flip chart, but on TradingView, and I'm sure other platforms have this as well, but you can just press Alt-I or Option-I on Mac, and it'll flip the chart for you. So this is a weekly chart of Amazon, and if you press Alt-I or Option-I on Mac, then it flips the chart for you. So if you're struggling to see what the bear case is here, if you're a bull, or if you're struggling to see the bull case if you're a bear, flipping the chart can often help to get the perspective of the other side to help you make better decisions. Hopefully that helps. Shorter chapter, but I still think some important points in there. So yeah, I'll see you all in the next one. If you have any questions or comments, please let me know in the comments.